Stop what you're doing right now. If you own or follow regional bank stocks, you absolutely need to hear this. You know that ultimate gut-wrenching fear for retail investors, right? A company posts what looks on paper like a fantastic earnings report, you confidently buy in, and then you watch the stock just flatline, inexplicably. Well, last week, I dug deep into Customers Bancorp's Q1 2026 results, ticker symbol CUBI, and honestly, what I found totally shocked me. It completely unpacks the mystery of how a stock can beat Wall Street's top-line expectations and still go literally nowhere. Welcome to this explainer. By the end of this, I promise you'll have a clear, actionable framework for cutting through all that headline noise so you can see the true, concrete value of this bank. Let's get right into it. So let's start with the obvious tension here. Core earnings per share came in at $197. That safely beat the $189 analyst estimate. Great, right? And revenue? It hit $225.7 million, which is a massive 15.7% year-over-year growth. Yet, immediately after this report dropped, the stock remained perfectly flat, just stubbornly hovering right around $77.52. This raises a bold question that should honestly make any investor stop and think. What exactly is the market seeing that those rosy top-line headlines are missing? Is this a hidden trap, or are we looking at a completely misunderstood gold mine? This comparison right here brilliantly illustrates the mixed nature of the quarter. On the left side, you've got your traditional measures of success. Revenue is up and profit per share beat the street. All good things. But look over at the right side. Investors were clearly spooked because the absolute cornerstone of traditional banking predictability missed the mark. I mean, think of net interest margin like the engine of a car. If that engine is sputtering, it really doesn't matter how shiny the new paint job is, does it? When this metric misses expectations, Wall Street immediately hits the pause button, regardless of how great the rest of the report looks. Section 1. Unpacking the NIM compression. Okay, so net interest margin, or NIM for short, just as a quick refresher, this is basically the difference between what a bank earns on the loans it issues and what it pays out to depositors. When this margin shrinks, the bank's core profitability gets squeezed. And what's really interesting here is seeing that stark sequential drop visualized. You can see Customers Bancorp's NIM fell from a very healthy 3.40% back in the fourth quarter of 2025 down to 3.22% in the first quarter of 2026. A nearly 20 basis point compression in a single quarter, yeah, that is significant. Reversing its upward trend, this squeeze directly caused sequential net income to drop compared to the previous quarter. But hold on a second, because context is absolutely everything here. This wasn't some sudden systemic failure of the bank's operations. Actually, it was an expected reversion to a lower baseline. Management had explicitly warned everyone about this. In late 2025, the bank benefited from a one-time discount accretion tied to a loan portfolio buyout. Basically, they bought loans at a discount, recognized that extra value on their books, and got a temporary accounting boost. It was kind of like using financial training wheels. Well, with that one-time benefit fully realized and fading away, the core NIM is just reflecting reality without those training wheels. So it was an expected mechanical shift, definitely not a fundamental breakdown in their lending strategy. Section 2. The core engine. Tangible book value. Moving beyond those margin compression fears, we really need to examine the premier banking metric. Let's just forget the quarter-to-quarter noise for a second and look at tangible book value per share, or TBVPS. This is the ultimate no-nonsense measure of a bank's true, rock-solid value. Why? Because it intentionally strips away all those questionable intangible assets, like goodwill. What you're left with is a concrete per-share net worth that fiercely resists any financial engineering or clever accounting manipulation. You know, earnings per share can sometimes get murky with acquisition impacts or flexibility around loan loss provisions. But TBVPS, it cuts right through that noise. It shows you exactly what the bank's assets are worth in the real world. And here is a number that should definitely make you pay attention. $63.54. Customers Bancorp posted this massive tangible book value per share for Q1 2026. And this isn't just a static number, folks. It marks a 16.1% year-over-year increase. Even more impressively, it showcases an incredible 16.2% compound annual growth rate over the last 5 years. That is huge. So while headline traders were out there panicking over a mathematically expected NIM compression, the actual concrete equity value of the bank was quietly continuing a multi-year trend of double-digit percentage growth. This underlying engine of consistent, compounding tangible book value growth is exactly why the bank has garnered some major industry accolades. I mean, they were named a top 10 performing bank by American Banker for 5 consecutive years, from 2021 all the way through 2025. They even grabbed the #1 spot in 2024 for mid-size banks. This visually cements the difference between knee-jerk, short-term market reactions and long-term, recognized operational excellence.
Section 3. Cubics and institutional growth. So let's explore the catalysts driving this flywheel forward today under the leadership of new CEO Sam Sidhu. Even with a pretty challenging economic environment out there, Customers Bancorp delivered solid organic balance sheet growth. They reported 15.3% year-over-year loan growth, which really proves their commercial-oriented, high-touch lending model is working exactly as intended. On the funding side, they netted over $800 million in deposit growth just in the first quarter alone. The balance sheet is accelerating, and it's doing it rapidly. But hey, it's not just about the sheer amount of deposits, it's the quality that matters. The bank successfully pushed its non-interest-bearing deposits to a record 31.2% of total deposits. That represents an absolutely astonishing $6.7 billion. To put that into perspective for you, they added over 1,100 net commercial accounts in just 3 months. In today's banking landscape where literally everyone is fighting tooth and nail and paying crazy high yields just to attract deposits, securing nearly a third of your total deposits without having to pay a single cent of interest on them, that is a monumental advantage, a real game changer. And this deposit explosion, it is definitely not happening by chance. It's largely driven by their strategic rollout of the CUBI's instant payments platform into traditional industry verticals. Management is purposely shifting the platform's focus beyond the often volatile digital asset space, and they're deploying it into mortgage finance and real estate. This is honestly a brilliant strategic move. It allows them to capture sticky, low-cost institutional deposits, meaning money that just stays put rather than constantly chasing the highest yield, from traditional finance sectors. And importantly, they're doing this without taking on any additional credit risk. Section 4, the 2026 Outlook. So, how does management plan to keep this organic growth spinning through the rest of the year? Well, they've laid out a very clear 4-pillar roadmap for 2026. First up, they are heavily targeting an increase in AI and automation utilization to boost organizational productivity and the overall client experience. Second, they plan to deepen and broaden those all-important payments capabilities into new industries. Third, they're targeting above-industry average loan and deposit growth, which is going to be fueled by their strategy of aggressively recruiting top banking teams. And finally, they aim to achieve all of this while maintaining robust asset quality and risk management. And they're certainly walking the walk there. They're currently boasting an incredibly low non-performing asset ratio of just 0.29% of total assets. That means their loan book is remarkably, incredibly healthy. As we wrap up this explainer, I want to leave you with a final thought. When you peel back the layers of what Wall Street quickly labeled a mixed earnings report, what do you really see? With net interest margin compression heavily representing the mechanics of past accounting benefits just quietly sunsetting and surging low-cost traditional deposits pointing directly to future profitability, are the headline fears actually masking a fundamentally accelerating banking engine? Does the reality of a consistently growing tangible book value completely outshine the temporary fear of compressing margins? I'm going to leave you to ponder that one. Thanks so much for joining us, and remember, always keep looking beyond the headlines.